McDonnell is head of equity strategy at BNP Paribas. He joins in now. Clive, morning. Thanks for joining in. Your call is an interesting one. Overweight China, underweight India. Take us through why.
Yeah, the core of our view really centres on what we see as a lot of earnings risk in India going forward compared to a lot of earnings realism in China. Looking at about 30% EPS growth this 2011 financial year in India compared to about 14-15 in China. The key concern, though, is the exposure of India to Europe. When we look at the breakdown of Indian corporate earnings in terms of the geographical spread, we see that India has a higher proportion than the regional average coming from Europe, whereas China, in actual fact, has one of the lowest portions of its revenues coming from Europe. So we see significant risk into the second half of this year of earnings downgrades in India coming through because of the situation in the Eurozone.
Clive, morning. It's interesting you say that because we've come out from a rather patchy earnings season performance this time round. How deep would you say is this downgrade risk in terms of how much earnings may have to be scaled down by?
Well, very difficult to say exactly where we could finish up for FY11. As I say, at the moment we're looking at about 30% as the consensus number. What's noticeable, though, is that India is the only market in the region which actually sees an acceleration of earnings into next year. Not just China will see a deceleration into next year, but every other country in the region. Now, of course, India has significant domestic demand drivers, but this reliance, greater than average reliance on Europe as a source of revenue is a source of concern for us. When we look at the earnings revision index, which is a lead indicator for EPS today in India, it's still remaining very, very positive, but we think that is out of line with what some of the fundamentals in terms of the sources of that revenue would suggest.
Has this Europe sensitivity been drilled down to specific stocks that you're worried about, Clive, or is it sectors that you would want to avoid?
I think it relates more to sector-specific issues, specifically in the auto space and also in the tech space are two areas of concerns for us. Where particularly in tech, we've seen some solid earnings coming through, but some uncertainty in terms of the outlook. So we have some concerns there, and also in the auto space. While obviously domestic auto in India is doing very well, in terms of some of the new export markets, there may be some shadows emerging from that going forward.
What about the commodity space, Clive? Names like Tata Steel, etc., which have exposure to Europe through Chorus, would that be any kind of risk to earnings?
Yes, but I think it has to be more on a company-specific basis, because we are actually quite positive on the prospects for materials within China, steel, cement consumption. So as you correctly point out, Tata Steel with its reliance on earnings from Chorus, obviously that would be a negative factor. When we look at SAIL or some of the other companies and the impact of better-than-expected demand coming from China, we need to balance ourselves correctly or position ourselves correctly in terms of the individual stock exposure by region or by country.
You mentioned autos, so that's Tata Motors, which has quite a bit of exposure through JLR, but that announces results today, and for the last couple of quarters, JLR's turnaround has been one of the cornerstones of the Tata Motors stock. But do you think that kind of momentum or demand momentum will start flagging off in Europe?
Well, certainly in Europe, definitely we have some anxieties there. I think what's key, though, to keep in mind is that what in terms of the total level of output, obviously India dominates, but we're starting to see both India and China export models now into the European and indeed the Japanese market, and some investors or a lot of analysts are becoming more positive that in 5 to 10 years India could be a major supplier into the European market, and likewise China being a major supplier into the European and the Japanese market. So some of that optimism may have to come out of stocks in terms of valuations.
What about a space like IT, Clive, where there is a lot of back-endedness that's being penciled in terms of upgrades for earnings, and there is also a fair amount of exposure to Europe as a market?
Yeah, on the tech services side is a source of concern for us, and we've seen some of the companies highlight that there's some uncertainty in terms of the second half. And we've got sort of these, conflicting trends whereby, weakness in the Eurozone economy obviously would accelerate the outsourcing trend. But then you've got individual companies within India highlighting that economic certainty is sort of creating some clouds in terms of the future deal pipeline. pipeline. So we do have some concerns there. We think maybe some of the tech hardware is a better place to be in IT in the second half of this year.
This valuation discomfort has become a much stronger post Q1 earnings performance, Clive, and yet every day this market is pulling in a lot of money, much more than its regional peers. What do you make of that disconnect?
Well, I think it depends which individual data source you're looking at. When we look at the foreign fund flow data, India has been sort of also ran over the past couple of months, and also when we look at the institutional foreign ownership data that came out for the second quarter, we've seen foreign ownership pull back a little bit by about a percentage point or so. So I think that investors I think the key trend at the moment is that investors have a lot of exposure to India, foreign investors that is, whereas they're dramatically underweight China. So I think in terms of the balance of flows going forward, we're likely to see more of that foreign fund flows go towards China, where there's a big underweight relative to the position in India, where depending on the particular data source you're looking at, foreign is rather neutral to maybe a touch underweight.
So are you calling for a big correction or a reasonable correction in India, or are you only saying that it will underperform in a relative sense?
Absolutely, the latter. We're not looking for a big correction in India. The growth story is still very, very solid, and the demographics story is still in place. Going forward, we look for about 8% upside for the Sensex. But that compares with China, where we've got a much more significant upside for the index there. So this is very much a relative call. We're not suggesting that the Sensex is about to drop 10 or 15%. Rather, we think in terms of alpha generation going forward, there's greater profit opportunity in China versus India. And that's a reverse where we've been over the past 12 months. Up until June, we were recommending investors to maintain an overweight position in India versus China. But now, on the 21st of June, we changed that stance and switched our overweight recommendation into China going forward.
On that ownership pattern you were alluding to, I think it's your domestic peers who have put out that report over here, Clive, and they've also mentioned that the key overweights remain spaces like banks and staples. Would that be your preferred sectors to maintain exposure with in India?
Yes, I think selectively in the staple space and also in the private sector banks, we remain relatively positive. I think other areas though that we continue to like in India is the infrastructure space, but more specifically second-tier infrastructure companies such as Compton and Greaves, mainly because of the valuation argument. We see better value in the second-tier infrastructure names, as I say.
Mcdonnell, appreciate you joining in this morning with your thoughts. That's BNP Paribas with a slightly more cautious view on India, especially on earnings, overweight China. They say things are quite